Whether or not you have QBI in 2019 completely depends on which suspended loss you're treated as using. If you're treated as using the 2018 loss, then you don't have any QBI. If you're treated as using the 2017 loss, then you still got 100,000 in QBI and you can take the deduction. And this goes back to what we said at the beginning, right? You close one door. Hey, you tell us what happens to suspended losses. But you open up maybe a bigger door, which is no one knows how to use suspended losses. So now you have to give us guidance on that. Can't win when you write this stuff because you can never just say, nailed it all, got it all covered. No one's going to have any questions about this.
Questions on the deduction that goes by the pass-through business deduction, the 20% deduction, the 199 Cap A deduction, and as I've generally been calling it lately, the qualified business income or QBI deduction, have abounded since the provision was created under the legislation formerly known as the Tax Cuts and Jobs Act. This newly created provision, effective in 2018, provides a 20% deduction of domestic qualified business income from partnerships, S corporations, and sole proprietorships to non-corporate taxpayers.
Mr. Simple?
You can call me Tax. What's your story?
Oh, Tax, something terrible has happened. My Quincy's gone missing.
Missing, you say? Tell me more about this Quincy character.
Well, his name is Quincy Benjamin Ingrid Donaldson, but everyone calls him QBID. He stole my heart.
Where did you first meet Mr. QBID?
Oh, I remember it like it was yesterday. It was January 1st, 2018. We were ringing in the new year.
All right, everyone, it's time for the countdown. Are you ready? 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Happy New Year!
Just feel it.
And here is to a 20% deduction of qualified business income on the tax returns of non-corporate taxpayers.
What? Who are you?
Quincy Donaldson. They call me QBID for short.
So how'd you get here? Did you take a taxi?
No, I traveled by boat from across the harbor. I just went into effect, but I'll be sticking around through 2025. At least that's the plan.
2025?
Yeah, unless the politicians ask me to make tracks sooner.
Could they do that?
Well, they could, sure. But it would have to be introduced in the House and make it all the way through the legislative process.
So what's all this nonsense about a 20% deduction anyhow?
Now that is a good question. Well, see, you're all a bunch of non-corporate taxpayers since you're individuals. And I'm here to help you as well as trusts and estates to cut the tax rate on domestic income that passes through to you from a trade or business as defined by Internal Revenue Code Section 162.
What about investment income?
No, investment income's not QBI.
Capital gains?
No, sir.
What about Section 1231 gains and losses?
Say, you're sharp, yes, but only if it's taxed at ordinary rates.
How about income from the trade or business of being an employee?
I'm gonna say no.
That's right. Wages and guaranteed payments to partners aren't QBI either. What's your name, doll?
Sally Sue Thompson Bright, but you can call me SSTB. What'd I say?
It's just SSTBs and I don't pair so well.
Oh.
But there is an exception in certain cases.
Oh, my poor Quincy.
Miss SSTB, sounds like the clock is ticking for Mr. QBID. Get right on the case. Where'd you last see him?
Place we first met, the 20% bar.
I know the perfect fellow who can help us out.
Hello?
Mr. Carl P. Albright, please.
Come on, Tex. You can call me CPA.
That's precisely why I'm calling. I need a CPA to help me find Mr. QBID. He's missing.
Oh?
You know the place below the line right before you get to taxable income?
The 20% bar.
Precisely. I could use your help cracking this code. Can I count on you?
Yes. You can count on me.
Great. Meet me as soon as you can.
I'll grab my things.
I'm gonna try and tally up some leads.
Can I come with you?
Best to play this one by the numbers, just to be safe. But I can give you a ride home.
That figures.
Hey, Carl. Good to see you.
Tex?
I want you to meet Miss Sally Bright. We're gonna be working her case.
Ms. Bright?
Oh, please, call me SSTB.
You can call me CPA.
All right, let's book it.
If it isn't Mr. Simple,
Mr. Simple's my father.
always one for a joke.
Just the facts, ma'am. Miss Bright, meet Miss Annie Story. Annie's the hardest working reporter I know.
You out for a rare night on the town, or am I right in assuming you're on the job?
Just working a case here for Sally.
What kind of case is this, anyway?
Possible missing person.
Missing person? Isn't that something the police should handle?
Not if there isn't any evidence of foul play.
I tried to file a report with the police, but they said Mr. QBID hasn't been gone long enough for them to make a case.
And you won't need to. Carl, we better get going.
Mind if I tag along? Mr. QBID makes big headlines here in Taxville, and I'd love to break this story.
I'll make sure you get your scoop, Annie. Right now, I just need a lead. Sally, we'll give you a ride home. Let's go.
Nice to meet you.
Well, if that don't beat all, if it ain't Mr. Simple. Good to see you.
Mr. CPA, meet the finest barkeep this side of the 1040. Mr. Can I Deduct It?
It's a pleasure, Mac.
Likewise.
Can. I'm looking for a fella. Goes by QBID. You know him?
Yeah, who doesn't? What about him?
When was the last time you saw him?
You know, now that you mention it, I haven't seen him in quite a while.
Perhaps he got limited.
Eliminated?
No, limited. There are limits that kick in once taxable income crosses certain thresholds.
What kind of thresholds we talking about for Mr. QBID?
Well, for the 2019 tax year, it's $160,700 if he's single.
And if he's married?
Then it's $321,400.
Right. Plus phase-in amounts of $50,000 for single and $100,000 for married filing jointly.
What's the lowdown on these limitations?
You better take a look at the menu, Tax.
Why don't you pour Tax a shot of wages to demonstrate?
Good thinking, Mac. You see, once taxable income exceeds the taxable income thresholds,
Plus the phase-in amount.
plus the phase-in amount, then the deduction is limited to 50% of W-2 wages.
And those W-2 wages must be paid and reported to the Social Security Administration within 60 days in order for them to count.
What if I don't have any wages?
Show him, Mr. Deducted.
What a waste!
And if I don't pay them, but it's my employee?
As long as you are the common law employer, you get to count them.
What about sole proprietorships?
No owner wages.
And same for S corporations?
Hey, you're digging it now. But only if you pay a reasonable amount of compensation for services provided to the corporation by the shareholder.
And the same for partnerships, I presume?
Actually, no.
No?
The IRS ruled that partners cannot be employees under Rev Rule 69-184.
And they got to be W-2 wages to avoid the limit. And guaranteed payments aren't QBI.
But you do avoid the reasonable compensation standard we mentioned earlier for shareholders of S corporations.
This is a tough pill to keep straight. Depending on business structure and choice of entity, you get very different results.
I don't think wages will be an issue for old QBID. Rumor has it, he's got half the town on payroll.
I heard some of the fellas the other day saying he owns half the town as well.
How's that play in?
You be asking about qualified property?
Yeah, what's the word?
It's complicated. Like these fellas were saying, the 20% of QBI deduction is limited to 50% of wages once the taxable income exceeds the thresholds. But you can also use 2.5% of qualified property plus 25% of W-2 wages if it's a bigger number.
Qualified property?
That's what I just said, I think.
He's right, Tax. The unadjusted basis immediately after acquisition, UBIA for short, of qualified property, to be more precise.
You weren't kidding, pal. This stuff is complex.
You think that's complex? Try ordering the excess section 743B.
Make you one, Tax?
Drinking and taxation doesn't mix on the job. But pour one for this fellow, would you?
Afraid I can't do that, Tax.
Why not?
Mr. Overall Loss here has deducted one too many tonight. So he's been limited. Just like the overall limit of 20% of taxable income on the QBI deduction.
50% of wages, 2.5% of UBIA on qualified property, plus 25% of wages when taxable income exceeds the thresholds, and an overall limit based on 20% of taxable income. Any other limits I should know about, fellas? I heard earlier about SSTBs and certain exemptions. I assume taxable income has something to do with that.
But QBI, he's got it.
I still don't know why it's significant if an activity is an SSTB or what one is in the first place.
Who's talking about SSTB?
Mimi de minimis.
Oh, hey, Mimi. This is Tax. Tax, this is Mimi de minimis of De Minimis and the Cliffs. They're performing tonight.
It's a pleasure to meet you, Miss de minimis. Now, will someone please tell me about SSTB?
Are you talking about my sister?
Sister?
What are you looking to find out about my sister?
Miss SSTB came to me earlier. Wanted my help regarding a Mr. QBID.
Is there something wrong with Mr. QBID?
I'm afraid he's missing, Miss de minimis.
Is this a put-on? He is not the kind of guy that gets behind the 8-ball.
I'm afraid not. Your sister was very distraught.
Are you sure he didn't just get limited?
You're the second person to ask me that tonight. No. It seems there was plenty of taxable income, wages, and UBIA of qualified property to keep him from getting limited.
What about SSTB?
Your sister? I don't suspect she had anything to do with Mr. QBID's disappearance.
No, I'm talking about a specified service trade or business.
Hi, Mimi. Mimi!
I'll be right there. Sorry, guys, I gotta skedaddle. Mr. Albright, would you take it from here?
Yes, Miss de minimis, you can count on me. Okay. You see, Tax, qualified trade or business excludes trades or businesses performing services as an employee and as an SSTB, specified service trade or business.
I know about the employee part, but tell me more about the SSTB.
It's any trade or business that involves performing services in the fields of health, law, accounting, actuarial science, performance arts, investing or investment management, trading or dealing in securities, partnerships or commodities, consulting, athletics, financial services, brokerage services, or if the principal asset is the reputation or skill of one or more of its employees or owners.
Impressive, Mac. You have an incredible memory.
But I thought to have QBI, you have to be a qualified trade or business. And if an SSTB is not qualified, how can it have QBI?
There is an exception.
Yeah, if the Joe claiming the deduction has taxable income under those threshold amounts we mentioned earlier.
An exception, yes. Now it makes sense why Mr. QBID and Miss SSTB's relationship seems to depend upon the year.
Right. Taxable income can change from year to year.
So some years you get the 20% deduction. Some you don't.
How do I know if I'm one of those services you listed off earlier?
Oh, you mean health, law, accounting, actuarial science,
all those services you listed earlier.
I usually listen to an episode of Simply Tax about Section 199 Cap A, or I write a letter to the host, Mr. Damian Martin.
Simply Tax, eh? I've recently started listening myself.
Cutting through the static of the tax world.
Wonderful, boys. Did you get tax all lined out on SSTBs?
We sure did, Miss De Minimis.
Swell. And did you tell them about the de minimis rule? Well, allow me. There is a safe harbor under the final regulations for Section 199A that allows you to ignore income from an SSTB if gross receipts are below certain amounts.
And what amounts would those be?
It's not treated as an SSTB if less than 10% of the gross receipts are from specified services, but only if the total gross receipts of the trade or business aren't above $25 million.
And if total gross receipts are above $25 million?
Then there is a 5% threshold for specified services.
Seems to me you sort of fall off a cliff if your SSTB gross receipts cross the threshold or your taxable income exceeds the phase-out amount.
Hence the name of Mimi's group.
I've got to go, boys. It's just about time for my set.
Maybe I will take that drink. 1040 easy, neat.
You got it, Tax. Hey, you know, Tax, there was a fella who came in here earlier. Looked like he had deep pockets, but I think it was all just for show. Anyway, he was spouting a whole bunch of malarkey, but I heard him say something about being able to get a 20% deduction on non-SSTB income. He called it a Kraken pack.
Kraken pack. Any idea where I can find this fella?
Yeah, he said he had a business meeting at the Fringe benefit later tonight.
The parking garage?
That's what I heard.
I better split. See what I can find out. It may end up being a plug nickel, but it's the best lead I've got. Can I get a ride back downtown?
Sure, Tex. Let me know if you need anything.
Thanks, Carl. Calculator.
I'll get the tab. Can I get a milk?
Lost, old man?
I'm looking for someone. Goes by the Pro.
What do you want with him?
I'm looking for some tax advice.
Is that so?
Word is that he's a whiz when it comes to creative tax solutions.
Well, mister, you found it. What can I do for you?
Rumor is there's a 20% deduction. I'm very interested in taking advantage of that.
20% deduction, huh?
Yes, but I don't fully understand how it works.
What do you do for a living, mister?
Doc Brown. I'm a dermatologist.
Right. And, you got a side hustle?
Skin cream.
Skin cream.
Do you want to try some?
I'm anti-skin cream, Doc. A pro at avoiding it. I'm smooth enough as it is.
I see.
Make any money off your skin cream funny business?
Yes, about 25% of my gross receipts come from it.
You're looking to knock 20% off your taxes on that, though.
That's it. Can you help?
Yeah, Doc. I got just the prescription for you. It's called Kraken Pack.
Oh, no. I don't do that sort of thing.
No, Doc, it's nothing like that. I'm talking about cracking off the skin cream business, packing it into a newly formed entity. It'll get you around that SSTB problem you've got.
Hold on, pal. You can't sidestep the SSTB rules that way.
Says who?
Says the rules under Section 199 Cap A.
Says you. You a copper?
No. You're a crumb trying to get this here fella in the hot seat by making a boondoggle of his taxes.
What do you know, pal?
The name's Tax. Taxation Simple, to be precise.
Oh, the famous private investigator.
PI, huh? Even worse than a copper.
we had this notion that if you did not allocate any one of those items, like if any one of them wasn't allocated, that they were all presumed to be zero, pretty cut and dry, that no, if you don't allocate one of those, it's just that particular item that's going to presume to be zero. And so I think that's,
Have you found my QBID? I can hardly recognize the tax roll without him.
Slip up in these disclosure requirements could taint everything. And then
That's it.
I think practitioners
Miss Bright, would you hand me yesterday's paper?
Sure, here.
Sometimes I think it causes more headaches than it does to solve problems, but in the right scenario, you got an entity that's just got a ton of its own businesses. You're certainly going to enjoy being able to aggregate at the entity level and just kind of knock it out there, so that when it gets to the owner's just kind of locked into that treatment. Doesn't have to make their own
Annie,
decisions, but again,
be in my office and then out. I've got your story. Tax world is complex, especially with the changes under the Tax Cuts and Jobs Act, which, of course, brought us Mr. QBID.
Where's Mr. QBID now?
Hold on now, that's not the right question.
What do you mean?
As you know, effective in 2018 and sunsetting on December 31st, 2025, new Internal Revenue Code Section 199 Cap A provides a 20% deduction of domestic qualified business income from a partnership, S corporation, or sole proprietorships to non-corporate taxpayers, individuals, or estates and trusts. We also know it can't be an SSTB unless taxable income is under certain thresholds. And if the income is above those thresholds, plus the phase-out range of $210,700 if single, or $421,400 if married filing jointly in 2019, the deduction is limited to 50% of W-2 wages, or 25% of W-2 wages, plus 2.5% of unadjusted basis immediately after acquisition of qualified property. And, of course, an overall limitation of 20% of taxable income minus capital gain that applies regardless of taxable income.
This is all fascinating, Tax, but where is my Quincy?
Not where, but who is he deemed to be?
Tax, quit with the miscellaneous deduction type information. You know the 2% deduction related to those is suspended until 2025.
That's right, Carl. I was getting there. Can you tell us what information a relevant pass-through entity is required to report on a Schedule K-1 issued to owners of a trade or business that's engaged indirectly by the RPE?
What's an RPE?
RPE is short for Relevant Pass-Through Entity, which is a partnership, S corporation, or fiduciary. An RPE is required to report each owner's allocable share of QBI, W-2 wages, and UBIA of qualified property attributable to each such trade or business, along with whether that trade or business is an SSTB.
Mr. QBID always said I'm reportable. But Tax, what does all that have to do with finding my QBID?
You see, Miss SSTB, Mr. QBID's not missing. Seems to me he just has an issue with the reporting rules of an RPE.
Please simplify it, Mr. Simple. I don't have all day.
Mr. CPA, would you please read Regulation Section 1.199 Cap A-6, Paragraph B, 3 little I.
If an RPE fails to separately identify or report on the Schedule K-1, or any attachments thereto, issue to an owner an item described in paragraph B3 little I of this section, the owner's share and the share of any upper tier indirect owner of each unreported item of positive QBI, W-2 wages, or a UBIA of qualified property attributable to trades or businesses engaged in by that RPE will be presumed to be zero.
You see, the relevant information was not reported by an RPE about Mr. QBID, and therefore, as a result, he's been deemed to be zero.
Oh no, my poor Quincy, he's gone forever?
No, he's not gone forever. I know a way that we can find him. Mr. CPA, will you please explain what the final regulations under Section 199 Cap A provide regarding failure to report this information?
The RPE reporting rules were revised in the final regulations to provide that if an RPE fails to separately identify or report the required information, It's only the unreported item of positive QBI, W-2 wages, or UBIA of qualified property that's presumed to be zero. This information can be reported to owners on an amended or late filed return for any open year.
Mr. CPA, would you do the honors?
I'd be delighted. May I?
Of course.
Let's go. Now we wait. It's
been warm today. Well, that was quick.
Oh, Cupid! Oh, I'm so glad you're no longer a zero.
Me too, SSTB. Thank you for seeing to it that all my relevant information was reported properly. What is it, Sally?
Cupid, is that you?
That's right, it's me.
You look so different.
Even I'm lost on this one.
I think I can help.
Damian Martin of the Simply Tax podcast.
Mr. Martin, it's simply great to meet you. We could really use your help.
Sure thing, Tex. I'm a huge fan of your detective work. So, if you want to find out why Mr. QBID here changed, tune into the special episode of the Simply Tax podcast, where we'll investigate why, we'll boil down the reason, and we'll explain what it means for non-corporate taxpayers everywhere.
Looking forward to it.